Welcome to the McGraw Council Show. We're bullish on the American dream, and we're bullish on your future.
Hello, and thank you all so much for joining us today. Today, we are blessed and honored to have Bruce Fain with Turtle Creek Financial Group join us today for the first of a 6-part seminar series. And Bruce, you've been on our podcast before. There's almost no introduction needed. I mean, we know your background. You were kind enough to share your life story, your business life journey, so to speak, in our podcast a couple of weeks ago. You joined us for a Facebook Live the week prior to that. You've got a very successful background. You're very good at what you do. But one of the other things that really sticks out is your passion. You're very passionate about this. And some of the things that we're going to be talking about today, it just relates to the small business owner on every level. And I am so excited to see what you've got for us.
Well, I'm really excited to be here, and it's an honor to be able to be on this podcast with you and to relay this information that we believe at Turtle Creek Financial is so important to small business. And so I hope that when we're finished here today, that not only will the small businesses that are here today be enriched with a little bit of information they didn't have before they got here, but will be really excited about continuing through the next parts of the series.
Absolutely. And that's the other thing you've been kind enough to help with as well. At the end of this seminar and the subsequent seminars as well, there will be a definitive action item so that those listening can take the knowledge you're sharing and put it into their business right away.
Absolutely. Absolutely.
Are you ready to get going?
I am absolutely excited and ready.
Fantastic. Well, we've got your presentation on screen, so please walk us through.
Okay, well, good morning, good afternoon, whichever the case may be, at wherever you're at. And I wanted to talk a little bit today about economic reality and your personal economy. And we're going to talk today because I know today you keyed in to look at the business of business. And like we talked about, John and I before, if you talk about the business of business, in a word, it's money. Money in and money out. So what we're going to do is we're going to look at the 3 types of money, and we're going to use red, green, and gold as our benchmarks for those 3 types of money as we go through. And we're going to look at the considerations of the characteristics, roles, and deployment of each. And in the financial environment, there's a lot of noise. I mean, you've got Susie Orman, Scott Burns, Dave Ramsey, you've got preferred stocks, 403Bs, 401Ks, corporate bonds, small blends, large blends, common stocks. It's just a whole lot to listen to and to decipher as you go along. But at the end of the day, there's only really 3 types of money. There's money at risk, there's money at rest, and there's money at work. And the reason we're going to do this to begin with, rather than jump right into key employees and the things that we're going to talk about through the series, is because we want you to understand what money does and how it works, because we know that your entrepreneurship is your greatest asset to your wealth building. And we want you to understand where your money needs to go and why it needs to go there, because we're not telling you that we don't think money at risk is a good thing or money at work is a better thing. What we're saying is, at the end of the day, in your life, with what you do, the money at work in your business is your best way to enrich your family and those that work with and for you. And money at risk for you is just that, money at risk. And we're going to talk about that, and we're going to dive right in right now. Money at risk is invested in equity assets with the hopes of growth and potential future income. And these investments may include stocks, mutual funds, REITs, ETFs, real estate, precious metals, cattle, coins, collectibles, Emmitt Smith rookie cards, Troy Aikman rookie cards, whatever you believe you can buy today that will increase in value over time to provide you with a wealth potential. Money at rest. Money at rest is these funds that are typically held in bank accounts for quick access, for living expenses, emergencies, and a certain amount of these dollars are savings dollars currently allocated to bank savings accounts. And money at work. Money at work is typically deployed as operating capital for your own a business you own or control, or contractual agreements with contractually agreed to outcomes, typically deferred, but sometimes they are immediate access. So we're going to jump right into it. Let's look at money at risk. Money at risk is invested in equity assets with the hopes of growth and potential future income. And I want your permission to over communicate a little bit today because I think it's necessary to just drive the point home. And contrary to popular slang usage, money at risk is not the same as money at work. Money at work will be discussed later in the presentation, but money at risk is just that. It's money at risk with a hope of a favorable outcome. And these investments may include, as we just stated, stocks, mutual funds, REITs, ETFs, common stocks, whatever, precious metals, cattle, coins, and collectibles, etc. And money may be put at risk personally through government-sponsored programs such as 401k programs, IRAs, and 529 plans.
Real quick, Bruce, can I jump in with a quick question here?
Oh, absolutely.
And there's an opportunity for attendees to ask questions later on. If you've got a question, go ahead and drop it in the comments. But really quickly, as an oversimplification, is it fair to say that money at risk basically means you don't control that whatsoever?
You know, that's a great point, John, because that's true. I mean, once you've put your money in the market, whether it's in stocks, REITs, or real estate, you've given that money to somebody else to take care of the profit or loss there. And simply stated, we believe that if you're going to be successful and you're going to grow your wealth, the most powerful and best way to do that is investing in your own enterprise. And when you put money to work, that's going to give you the best opportunity long term to benefit not only yourself, your enterprise, and your family, but also those that work with and for you.
Got it. 100%. Thank you so much.
You bet. We're going to look at money at rest. Money at rest is typically held in bank accounts, credit unions, or savings and loans. It's there for quick demand access for our living expenses, emergencies, and a certain amount of savings dollars are prudently allocated to bank savings accounts, and they also have the comfort of the FDIC protection. But you give up in the money at rest, the access and the living expenses, the convenience of having that money, you give the interest and growth opportunity up for the access to quick access to money. Does that make sense to everybody?
100%. We're following.
Absolutely. Money at work. This is important because we're about to explain the difference. Money at work is deployed as operating capital in your a business you own and control. It's also in contractual arrangements, with contractually guaranteed outcomes, typically deferred for some period, though sometimes immediate. Money at work literally has a job to accomplish. It's a tool. If one is a private business owner, they may take advantage of each of these above opportunities. If not, it's even more critical to put money to work contractually. Examples of contractual agreements include immediate income annuities, deferred income annuities, permanent cash value life insurance, reverse mortgages, deferred compensation, and most importantly, ladies and gentlemen, your enterprise. Your enterprise is money at work every single day. And we're going to look at a hypothetical using money at risk, money at rest, and money at work. And we're going to use an annual deposit of $6,000. And for most successful businesses, at $500 a month, they can do that easily. We're going to use an age 45 person, deposits and growth period of 25 years, and we're going to assume an income tax rate of 25%. Now, I know that could go up or down at any time. So for the sake of example today, we're going to use 25%. Also, we're going to use the money at risk. We're going to use a mutual fund portfolio. And we're also going to say, because DALBAR, that's DALBAR, It's a market analyst group. They've been in business since the mid-70s. And what they do is they check the investment behavior of investments over a long period of time, 20 to 30 years. And you can look them up on Google. They're readily accessible. They're a third party. We don't represent them. They don't represent us. But it's a fair market growth tool to measure with. Money at rest, we're going to use a bank savings account. And that bank savings account, we're going to give a 2% growth opportunity to. Whether you think that's too much or too little, we felt like it's in the middle of what we've seen over the years. And money at work, we're going to use today, with your permission, a permanent index cash value life insurance contract as our money at work tool. Also at the bottom here, you're going to see the encumbrances that come with the money at risk and the money at work and the money at rest, and how they figure into what you're actually going to have in value of dollars at the end of the 25-year period. So immediately, cash value to heirs would be $6,000 were that to be the case with encumbrances. Then the money at rest would be $6,000 at the first year. Money at work would be $370,000, and that would be accessed tax-free. Account value at the end of year 25 would be $225,000 cash value. And that's pretty good, less encumbrances after 25 years. Money at rest, I think this is an awesome deal. You've got money at rest in a bank savings account that's accrued $183,000 less the encumbrances that come with those assets. And then at the money at work, you have $225,000. That's pretty even with the money at risk. Wouldn't you agree? And having said that, the difference is you can access that income tax free. So it makes at least a 25% difference with that money at work. Cash value to heirs at year 25 would be $225,000 less the encumbrances. You can read those at the bottom of the screen. Money at rest, $183,000 in cash value, less encumbrances. $370,000 income tax free access at end of year 25. Projected retirement cash flow. Now, this is important because you're thinking, well, he's just reading numbers. Well, I'm not, because if you go back to the first, this is a business of business. And what we've done here is over the growth period of your business of 25 years, we've come full circle right now to your projected retirement cash flow. So now you've had your business, you've benefited from it, and now you're going to reap the benefits of the cash rewards that it provides. From age 70 to 90, that money at risk would provide you $9,000 a year less the encumbrances. That money at rest would provide you with a retirement cash of $3,660 less its encumbrances. And the money at work would provide you $23,000 a year annually for 20 years or more with an income tax-free income. But also for liquidity. And what's liquidity for? Well, liquidity would be for medical emergencies or funding long-term care, because now we're in retirement, things happen as the warranty wears off of our bodies like those cars. What are you going to have for those things? And it would be current cash value of your money at risk. It would be current cash value of your money at rest. But it's your money at work, again, your immediate cash value would be $75,000 that you could access twice during the exercise of the permanent index cash life policy, because it will provide you with insurance against catastrophic events such as a heart attack or a stroke, and it'll do that twice during the policy. But also it provides $160,000 over 3 years for age 85 or older. But you can actually access those things a little earlier. But those are cash values that money at work provides that the traditional money at risk and money at rest don't provide. So let's look at money at work. Would you hire an employee to work for you to build you a house under the following terms? You agree to pay them once a month until your scheduled move-in date. You plan to increase payments over time for inflation. Your employee makes great progress at times. Other times, they do nothing at all. And sometimes they arbitrarily destroy parts of the construction. They will not commit to having all or any part of the house completed by your scheduled move-in date. This is precisely what you're doing when you let someone convince you to put money at work in the stock market for your retirement. It's not built for that. You have no certainty of if, when, or how much your account will grow. The very fact that you are encouraged to deploy strategies, dollar cost averaging your paycheck, asset allocation to attempt to offset the inherent risk should be a red flag. Those methods simply are hoping your winners will offset your losers. Despite what the paid media and pundits say, money invested in the market is not money at work. It is money at risk. Red, green, and gold, your permission to over-communicate. In reality, there are three types of money, and they should never be confused. Money at risk. Money at risk is money invested in equity assets with hopes of growth and potentially future income. And these investments may include all of the following: mutual funds, the stocks, the precious metals, cattle, coins, and collectibles, etc. The money at rest. These are funds typically held in bank accounts for quick access, for living expenses and emergencies. And a certain amount we all put in bank savings, and that's a prudent move. Money at work. Money at work is typically deployed as operating capital for business you own and control, or in contractual arrangements with contractually agreed outcomes, typically deferred for some period, though sometimes access is immediate.
Can I jump in with a quick comment, Bruce, just for clarification?
You can.
You're not inherently saying that one is every single time better than the other, but you got to know what target you're trying to hit. So the analogy that I would give is a football game. Is it better to run the ball or throw the football? Well, it depends what you got and what you're trying to accomplish. Fair assessment?
Absolutely, because we're not saying that money at risk is a bad thing. It's not a bad thing. It's a good thing, but it needs to be put in its proper perspective. And that's what we're looking at here. Good question, John, because what we're looking at here is perspective. And today's seminar is on money at work for small business and how that's best applied. Because wouldn't you agree, John, that the best way to grow money is and put it to work is in your own enterprise, to grow that enterprise, because it for the people in the audience that are listening today, the money at work and their ability to control that money at work is their best wealth opportunity.
For sure. I mean, you've got a much better likelihood of success investing into your business and making that value grow rather than betting that the price of oil is going to increase. I mean, there are people who can do that, but you have a lot more control over your business than you do than the price of oil.
Well, you certainly do. And let's look at it from this perspective. If you look at UPS, that's a great success story, isn't it?
100%. It's a very, very good success story.
It sure is. And they use the principle of money at work. Because what they did as an entrepreneur is they took their money and they reinvested in their enterprise until such a time as it became such a powerful enterprise that they went to the market, and the money at risk people made them even more money.
Brilliant.
Does that make sense to you? Because that's what we're talking about today. We're not saying that our business owners shouldn't be in the market. What we're saying is it needs to be a prudent move and a well-defined move as to what monies you're going to put there and what the purpose of it is. Does that make sense?
100%. You just really clarified a lot in that last sentence. Thank you.
Yes, sir. So, your family security is very much like a house. Dedicated assets are intended to protect shelter you and your loved ones from life storms now and during your golden years. Because like the hypothetical that we use for money at work, you're growing a business, you're maturing the business, and you're retiring from the business, whether you passed it down to relatives or you sold it outright to investors. And at Turtle Creek Financial Group, we specialize in assisting clients in deployment of arrangements that are most definitely money at work at the highest level on your behalf. Money at work. For over 30 years, Turtle Creek Financial Group has specialized in money at work strategies to assist our clients in meeting their personal and business financial objectives by the most predictable and reliable methods available. Our philosophy: protect assets, grow wealth, live well, is predicated on those principles. Whenever possible and appropriate, we promote money management by contract. Remove the natural human reactionary element of greed and fear. Allow your assets to be managed on an institutional level with a major safe money portfolio. Okay, and let's understand, every well-managed portfolio has defensive reserves. Wouldn't you agree, John?
Oh, absolutely. You have to have some plan B, plan C type thing. You have to have some hedging.
You do. We provide clients with a peace of mind that is only afforded by major insurance companies' financial strength and the National Association of Insurance Commissioners model regulations. Eliminate the need to make active asset management decisions during retirement.
Can you quickly clarify that last point for us? What does that exactly mean, or how does that apply to the small business owner? What's an example of that?
Are you talking about eliminate the need for active management?
Yes, sir.
I can, and that's a great question. And here's the answer to that question. Basically, for the small business owner, what they want to do is they want to put their money in a contractual situation so that they know what the growth or access to capital is going to be at the end. Because the money they put in the market, the money at risk that they use, they don't know how much that is. Ask people from 2008, 2001. They don't know. And when we sit down with our clients, what we're going to do is we're going to assess what they need to do to put money to work as a tool so that they can maintain their business integrity and also maintain because they're not just feeding their family as business owners, they're feeding families.
Exactly. And man, you touch on a really good point there. Because we do have time constraints, I won't go off on a tangent, but that is a really, really good point. There's a lot more at play than one individual or even one family in small business. It impacts a lot of people.
And let's go one step further. Since you asked the question, I'm not going to go on a tangent either, but I would submit to you this. We talked about in our prior conversations about having a friendly relationship with your banker. Well, this right here, having assets under management with contractual agreed outcomes, gives you cash reserves. So if you needed to go to the bank, you have the assets and resources available to secure that if you needed to. Does that make sense?
100%. 100%.
Makes your business a lot stronger. And a lot of the business owners out there, John, as you well know, many of them have 90% or thereabouts of their personal wealth tied up in their business. What we're going to talk about in these contractual decisions is how to build wealth outside of that business so that they don't put both business and personal things at risk at the same time.
Again, back to that strategic framework.
Absolutely. So we're going to look at working capital and planning focus. Stop. Key employees, partners, family, heirs. And then there are the, vertices that go with those. Indemnity against loss of a key employee. retention of a key employee, partnerships and the buy-sell opportunities that it presents, family, and the need for income replacement or something to happen that took the breadwinner out of the family earnings early. Retirement, everything went great. How are we going to live those golden years in retirement? Heirs, legacy, estate equalization and legacy. Solve the owner's problems. Stop. And what does stop represent? Well, it provides security. It reduces taxation. It creates options for the business owner. And it increases the probability of success. Our process begins with focused discovery in the 4 key areas defined above. After an appropriate assessment of your objectives, priorities, and resources, we offer strategies for putting money to work to accomplish the key jobs dictated by your goals. Finally, we facilitate the implementation of the appropriate contractual arrangement. Stop. Your enterprise, key employees, partners, family, the core issues of your enterprise, and those things that are associated with those core issues. And what we do is we address these issues, key employees and partners, to protect these areas that are dear to us all, family and heirs. Money at work. Do you feel there are any areas we fail to address? Which, if any of these areas, might be of concern or interest to you? Do you have a time frame to accomplish specific goals referenced above? John, it's been my pleasure to present this, and I hope the people watching understand that the reason that I wanted to put the 3 types of money out here is because I wanted them to understand that the business of business is money. And we're going to talk about now the key employees, something I know everybody's interested in talking about. And probably some of them are going, what does that mean? And I want to explain exactly what that means.
Perfect. So I was going to ask you to elaborate a little bit on that. One of the things I think is really important for that small business owner to really keep in mind as they have that strategic planning topic, so to speak, that key employee can be you, the solopreneur. That doesn't mean, it doesn't exclude you. You can be the key employee.
Well, I tell you what, a lot of probably the people watching are key employees. And if you're a single proprietorship, if you are the face of the business, it's more important for you to listen to what has to be done here than probably anybody else. And I'm not saying that anybody that has multiple employees shouldn't be listening. On the contrary, they should be too, because what we're going to talk about with regard to the key employees, I think will be eye-opening to a lot of people. And we've got it put in a simple, straightforward form to where when we're finished today, when you look at key employees, there are some actionable things that you can actually do on several levels to look at where, as an entrepreneur and in your business, where you are with regard to that and how you could address that.
And that's a really important one. I mean, as we all know, as small business owners, that HR, human capital side, so to speak, it's essential to our business, and understanding how to retain key employees. I've been in situations where I've worked with key employees, and if they go, you've got a real problem. It may not necessarily kill the business, but it can set you back. And if there are ways, and maybe this is the best way to ask the question, are there specific things that small business owners can do to ensure they retain those key employees?
There absolutely are ways and things and methods that are available to business owners that are very affordable. It's just a matter of, like we say, putting money to work in those areas so that you can do it.
Okay, perfect. So question for you, Bruce, here. It's 12:15, and I know you're on a schedule here. Do you have a second presentation PowerPoint today, or is that in the following seminar?
No, I'd like to go ahead and present the key employee if we have the time.
Please.
If not, let's move forward and we'll use that next week.
Awesome. Well, if you got the PowerPoint, let's pull it up, please. because this is something, again, is very near and dear to my heart, so to speak. Too often, small business owners get focused in on working in the business and they neglect to account for that key employee. Then, at some point in time, the key employee leaves and they're almost like starting from scratch again. And it's like a kick to the gut. There are ways that you can retain that key employee and prevent them from leaving. I mean, it's the same thing as retaining customers. It's 7 times more expensive. We've mentioned this several times. 7 times more expensive to acquire a new customer than it is to retain an existing customer. But it's the exact same thing for employees. It is far more costly to onboard, recruit a new employee than it is to retain an existing one.
And not only that, but you also have to look, because you're hitting a good point, but think about just trying to find that next key employee. And what's it going to cost you? How many people are you going to have come in to train to do that don't work out?
Exactly. So it's not 100% batting average between the recruiting process, the interview process, the onboarding process, and then after that, you still have to retain them for an extended period of time to really get the ROI on that.
Yes, and a lot of times with key employees, I mean, you have a really good employee there, it may take 2 people to replace that one,
Hmm.
at least for a couple of years. And where do you get the capital to put that in play in small business? Those are big dollars.
Exactly. Exactly.
Well, I'm up and ready with the second presentation. If you're ready, I'm ready.
We've got it on the screen. Let's roll.
Awesome. Well, every time that I come on, ladies and gentlemen, what you're going to see is economic reality and your personal economy. Why? Because there is economic reality that you face every single day as an entrepreneur, because you pay the light bill, you pay the lease, you buy the gas for the vehicles, and you pay the internet costs and all the things that go with being in a business. And your personal economy, what goes on in the stock market and all the other places out there, are out of your control. But your personal economy and how you manage your business and your personal economy is in your control. And that's what we want to talk about. So every single thing that I'm going to present is going to start out that way, because that's the way we do it. Because we're not looking at market cycles here. We're looking at life cycles. And what we're doing is putting you in the best possible position for success. And I'm going to get started right away with the business of business and how to retain, motivate, and reward key employees. We're putting money to work. You are putting money to work. And I'm going to start off with this, and I want you to think about this. You might want to write this down. Take away my factories, my plants, take away my railroads, my ships, my transportation, take away my money. Strip me of all of these, but leave me with my people. And in 2 or 3 years, I'll have it all back again.
Wow.
Andrew Carnegie. Take away my people, but leave me my factories, and soon grass will grow on the factory floors. Take away my factories, but leave my people, and soon we'll have a new and better factory. Andrew Carnegie. Those are powerful things. I put that on there because the first time I ever read that, I thought, wow, now that is a confident, competent individual. We want to follow that. Key employees. Key employees are often the backbone of a successful business, the loss of whom can be have devastating effect on profitability. We work closely with managing owners to assist in the implementation of solutions to these pressing concerns. We facilitate plans to designed to retain, motivate, and reward key employees on a selective basis at the discretion of the employer. Here we are back with the general problems: key employees, partners, family, heirs, and the vertices that go with them: indemnity and retention, buy, sell, income replacement, retirement, estate equalization, legacy, assets, buy and sell opportunities, comfort, and death. Assets, buyout, comfort, death. Stop. Increase increase the security by de-risking the business, reduce and eliminate taxation, increase your overall options, and increase probability of personal financial success. Key employees. When considering the consequences of the loss of a key employee, we use an acronym, REPLACE, to measure the possible impact for your business. Revenue, R. What might happen to your overall revenue at the death or departure of a key employee? Employee morale. What impact might that loss have on your other personnel? Plans for the future. What impact might that untimely departure have on your future plans for your enterprise? Leisure time. Might that loss interfere with your well-deserved leisure time? Accounts. Will the loss impact any of your key accounts? Of course it will. Lines of credit. Here's a big one. Do you think the bank will be eager to assist a business that has lost a key player? Not in my experience. Exit planning. Most importantly, what about your plans to exit your business someday? Employee indemnity and retention. Key employees indemnity. What's indemnity? Indemnity is compensation for loss or damage in a monetary way. Indemnity. The loss of a key employee to death is a tragedy on many levels. However, the impact on your business may be buffered by key employee life insurance payable to your business. This is accomplished by a policy on a key employee's life, owned by the company, paid for, and designated as beneficiary your company. What that means is you're indemnifying your business against loss of a key employee. Now, that's not heartless, that's smart business, because were that to happen, as sad as that may be, it would impact in a most profound way. We just discussed that in the description of replace, how that would affect your operating capital of your business. Retention. Retention's a little bit more intricate, and the retention strategies aren't quite as simple. Key employees are likely to look to improve their circumstances. I think we'd all agree with that. They are even more likely, if they're good, to be subject to being recruited away from you. Is there reason to believe that a raise of $1,000 or even $2,000 a month would prevent a key person from taking a competitor's offer? Probably not. Money isn't the only thing. There are other things they may offer a key employee to lure them away. Another bit of wise management counsel from Andrew Carnegie. You must capture and keep the heart of the original and supremely able man before his brain can do its best. An effective retention strategy must have 3 elements: reward, recognition, and a time frame to perform. Instead of paying out an additional $1,000 or $2,000 a month that may not accomplish your objective, indeed may just be money gone, we recommend you put that same money in a vault in your office with your employee's name on it. Establish terms to be satisfied, the duties they've got to carry out, the years of service that are necessary, and in exchange, you will transfer the funds to your employee on a very tax-favorable basis for both you and the employee. Golden handcuffs, golden parachute. Money in the bank for you and your employee, and you provide longevity for you and your business and continuity, but you also do the same for the family of the employee that you're taking care of. If the employee does not comply, you keep the money. This strategy to put a portion of your operating capital or cash reserves to work to retaining employees satisfies the element of reward, recognition, and a time frame to perform. 5 to 15 years based on your goals. A document is executed to formalize this agreement and signed by both parties. To add even more weight to your demonstrated concern for your employee, we add 3 current additional benefits for the employee: a death benefit for their loved ones at a far lower cost than term insurance, a long-term care benefit in place for old age, and an agreement to pay them $50,000 or $75,000 tax-free in the event of a major illness such as a heart attack or a stroke. This overall strategy is an invaluable way to put money to work to amplify your business value and enhance its future solubility. It provides the key employee immediately with a tax-free death benefit for its family for something to happen. It'll also cover critical illness with tax-free lump sum availability, and it will provide a long-term care funding were that to be necessary. The benefits below are built into a state-of-the-art key employee retention life insurance policy with no additional expenses. Your enterprise, its general problems, indemnity and retention of key employees, and the buy-sell opportunities for the business partners, and the issues that go with the indemnity against loss or the retention of a key employee. And we insure these areas to protect these areas: family and heirs. Next steps to implementation of the key employee strategies are apply for the desired index contracts, assess key employee value to your business. There are formulas which may assist you with this, and prepare appropriate documentation, retention agreement, employee consent filings with carrier or federal government. Turtle Creek Financial Group is not a law firm and does not provide legal services. Turtle Creek Group will make sample documents available to you and your attorney, as well as provide guidance to the attorney in document implementation. We have subject matter experts, non-practicing advanced planning attorneys available if needed to guide local counsel. Asset impact on remaining 3 planes of stop, adjust accordingly. John?
Man, that was fantastic content. Very educational. So that last part, that last half, the key employee part, for the small business owner, is it a fair statement to say that their to-do list, so to speak, would be go identify those key employees and on a scale of 1 to 10, rate them how important they are to your small business?
You know, that's true, but I'll tell you something else you might consider. When you do a corporate evaluation, you want to look at what the value of the corporation is, and then look specifically at what the monetary value of that key employee is. In other words, what do they bring in sales revenue? What do they do if they're a project manager in the field, if they're a computer analyst in the office, whatever it is that they do, what portion of income do they provide to the overall company, and how would you insure that to indemnify the business? Or what would you do in that same vein? What would you offer them in a retention package?
And that's where some small business owners might know exactly what to do. Most probably have an idea, but they don't know some of those really important specifics. That's probably the right time and place to be giving you a phone call. It's just to kind of go into detail a little bit more and say, hey, I know I've got some key employees. I know they're important. I know I need to retain them. I don't know what the best strategy is. That's when you bring in that subject matter expert such as yourself.
I couldn't agree with you more. And if somebody is interested in how do I do that, I have a step-by-step that I can sit down with them, even on the phone for the first interview, and talk to them about check these things and look at these aspects, and it will give you a great picture to begin to put together that plan.
Excellent. Fantastic. Bruce, I know you've got places to be, but I cannot thank you enough for sharing your knowledge, your insights on these key areas. And I've said it before, I'll say it again. Retaining key employees to the small business is a hugely important component to their success, not only in the short run, but especially in the long run. You have to identify those key employees. You have to identify how to retain them. And if you don't know, that's okay. That's why there are subject matter experts out there. And someone like you can give a lot of value. I mean, even today, this seminar cost absolutely nothing to watch other than quite probably eating a sandwich during your lunch hour and watching something educational. You learn
Absolutely.
something, you find something you can apply to your business, and you build it into the system/process that you have.
Absolutely. It's been my privilege and honor to serve. And if anybody out there is interested in any part of this and don't understand any part of it, give John a call or me a call or email he or I, and we'll be glad to help.
And we'll be putting your contact information in our newsletter and on some of these posts as well that we're going to do so people can reach out to you directly if they need help. But just as you said, I'm always here for people who are already part of our membership and they are interested, they know they need you, they just don't know next steps. We can help you get there.
Absolutely. And a lot of times with people that you are already in business with, they'd like to call you first just to get your take on who is Bruce and why should I call Bruce? And I'm for that because we have a great relationship and we've been together for several years.
Absolutely. Absolutely. Bruce, thank you so much for your time. You stay safe, stay blessed, and I'll be sending you some of these edited versions over the next several hours.
Awesome. Have a great day. And to all of you, have a great day. And I wish you great success here forward. Thank you.
Take care. Bye-bye.
Bye-bye.